This is going to be the biggest crisis ever documented in modern history.
Take 2008-9 crisis, multiply it times 1.5. This is going to be 50% worse, 50% deeper, 50% longer.
Something is going to break, and it's going to be a major headline, and it's going to be like a panic event. That it always happens, and so this is coming. This is coming in the next 90 days, and it'll be a front page headline, all right? Let me just make it easy for people. The reason why is because you had easy money for 14 years, and you just took all the easy money away.
We have swelling global debt. It's ballooning, and it will continue to balloon until we get a bursting of that debt bubble, the debt market hyper bubble, which is being fueled by design. The larger they can make the global debt bubble, the bigger the bang.
A crash like this, you'll see 3 waves of crash. What we've seen is the first wave down. And of course, that's the most important one, because if it's 10 or 20%, then it may not be the beginning of a larger crash. We can always go to new high. This one was 35% on the NASDAQ, 25% on the S&P. So that 30% plus range qualifies it as yes. This looks like the first crash, which means now we're in the bounce from that crash where everybody can say, oh, it's over, and one good jobs report, okay? You know, how much is job stuff? We're still catching up from COVID and stuff. So we are in a recession. All the signs point towards a recession. Everybody says it's going to be shallow. That's what the experts say every time we have a recession. Here's the truth about this thing. This recession, it started in 2008-9, which is really more a depressionary period from such a bubble of such a magnitude. That should have been deeper and longer. That crash should have gone into mid-2010 and been a lot deeper. Stocks should have been down 80%, not 50-some%. So they blew us out of that. Now, despite stimulus, they overreacted to COVID, which was a huge mistake, because now they have to tighten because they overreacted to COVID, and COVID is a temporary crisis by definition, not a long-term crisis. But the economy is getting weak again. Now I'm just let people figure something out for yourself real quick. Let me tell you what happened during COVID. $5.1 trillion in fiscal stimulus and $5 trillion in monetary stimulus in 2 years, almost half of GDP, and we're already falling into a recession again despite that, okay? It shows what I'm saying. The economy is weak because the baby boom peaked back in 2007. We're in the weakest part of that downturn demographically, the biggest demographic downturn in history, until about 2024, still a year and a half from now before we start to recover. So this downturn is going to have to be deep to wash out all the debt and all the bubble stuff. We can't just come roaring out of this and say we're over it. This is the first wave down. We may be close to the end of this bounce. So consider, here's how it goes. A first wave crash down, 2-wave counter trend, okay? Retraced 40 to 50%. We retraced about 40% now, so this could be over soon. Then you get the next wave down. That's called the 3-wave. That should be the same size and length of this wave or more. So we're probably going to see another wave down from sometime this month into January of next year. And if the market's down into January 2023, just the January indicator would tell you the whole year is going to be down. So that'd be the next wave. Then you'll get a bounce, and then the final wave will come into late 2023 or early 2024. That's what you should expect after a bubble of this magnitude, especially one that's been stretched and stretched and stretched. The economy's never been able to wash out all this excess. $600 trillion of financial assets that are more overvalued than any time in history. Frankly, and I show this in my newsletter to tell our subscribers, is we have $600 trillion now in financial assets, 6.5 times GDP globally, and that normally would be 2 times GDP in normal time. So this bubble has to unwind. That means hundreds of trillions of dollars of financial assets. What is that? Real estate, stocks, bonds, commodities, gold included in there, all have to deflate back down to normal so we can come out of this. And we have to flush out bad debts, the highest debt ratios. Can't even compare the debt ratios globally and domestically to the roaring 20s and past bubbles like this. So people need to understand, this is the greatest financial asset bubble in history. There is no soft landing to this, period. There is no magic way to get out of it. Now that this thing is cracked this far, I've been telling our subscribers for months and years now, they'll come to a point where they keep stimulating, but it's not enough and the economy breaks down anyway. We are in the beginning phases of that, and it's very, very likely this is going to continue. So don't listen to all of the clueless economists that never thought this could happen in the first place and saying, well, this will be a mild recession and the worst is over. I am telling you, it is not. And you are risking your assets if you do not take this seriously. And you got to remember, if they've been stimulating nonstop for 13 years and we keep getting a weaker economy, and that has been what's happened, okay? Ever since the 2002, they keep stimulating more, and the economy keeps falling to new lows, the stock market. And so people are going to start to see this isn't working. You can't keep a dead economy. They got sudden inflation because they created the biggest bubble in financial assets in history. Anybody, any young person today has no chance of investing in retirement where every market from bonds to stocks to real estate is so overvalued that at best it can go sideways for decades to come. At worst, it goes down and you lose money. We need to deflate this financial asset bubble so that things go back. Housing, what's the biggest problem in our economy? Young people can't afford to buy a house. You know what a house was, an everyday house was 20 years ago? $120,000. You know what it is now? $420,000. What does that do to your standard of living if you just got married and had 2 kids? Can't afford to buy a house. And if you do, you can't afford to buy anything else. And interest rates are artificially low. When they go back to normal levels, because government's pushing that, then all these mortgages and stuff are going to cost more. They have basically, we've been living in an artificial economy. You don't get something for nothing. You can pump it up for a while. Hey, I tell people it's this simple. If I want to feel good today, I can feel good. I don't care how bad I feel. All I got to do is take heroin or cocaine or something, or 10 cups of coffee, and I'll be up. Does that work? Is that healthy? No. We've been doing this for years, living on artificial stimulus, stretching an economy past when people needed to spend money. The baby boomers were overspending their money and buying all their houses in 2007. I predicted that 20-some years in my newsletters and books before it happened. Mark my words on this and shoot me if I'm wrong. Next few years, housing in the United States is going to go down 50%. You know what? People said that couldn't happen. It already went down 34%, and I predicted that, okay? Already went down 34%, more than in the Great Depression, not because the economy was worse than the Great Depression, nowhere near that. It's because we didn't have a bubble back then. You couldn't buy a house with no money down, with damn near zero rates and speculate like you could. In the roaring 20s, in that bubble boom, a house you had to put 50% down, and the longest mortgage you could get is 5 years with a balloon payment.